I get it. Taxes suck. You work your way to higher income, hoping to build wealth, only for Uncle Sam to take nearly half of your earnings. Then you hear about something called tax deductions, which promises you to massively drive down that tax bill. But then once you start crunching your numbers, they don't help as much as you really hope for. In today's video, I want us to dive into the world of tax deductions, from what they are, why they may not be as impactful as you've been led to believe, and the truth behind their impact. You want to stick to the end because I'll share some expert strategies to reduce your tax bill and maximize your financial potential. Like the video yet? Let's get right into it. First thing first, what is a tax deduction? If you already know what a tax deduction is, great. However, a lot of people can't differentiate a tax deduction from a tax credit, as since both reduce your tax liability, some believe they are the same. This is, however, a misconception. So basically, a tax deduction is an expense that you're allowed to deduct from your adjusted gross income before tax is applied. So if your income is, let's say for instance, $100,000 and you have deductions amounting to roughly $20,000, then your taxable income is $80,000. The logic here is that by lowering your taxable income, you also lower your tax bill, and in some cases even your tax bracket. Remember, the US uses a progressive tax system where your tax rate increases as your income rises. A tax credit is quite different from a deduction in that it is subtracted from your final tax bill rather than your taxable income. Generally, tax credits are considered superior to tax deductions because they deduct you tax dollars dollar for dollar. So even a small tax credit can give you a bigger tax savings than a deduction that is 3 to 4 or even 5 times as much. So do tax deductions really work? The problem with a tax deduction is that they aren't worth the value of the amount of money you spend. So what do I mean by this? If you're earning $100,000 a year, this puts you in the 22% tax bracket. Without deductions, this would mean that your taxable liability would be calculated as follows. The first $11,600 would be subjected to a 10% tax, which comes to $1,160. The next will be $35,550, would be taxed at 12%, which would be $4,266. And the remaining $52,850 would be taxed at a rate of 22%, which is around $8,627. So the total tax would therefore be $17,053. Now, let's say you decided to buy a $2,000 piece of office furniture, hoping to save the same amount in your tax bill. Now, your taxable income is $98,000. This means you still will be in the 22% tax bracket, and the amounts in the first 2 tax brackets will stay the same. The last, however, which is $52,850, will be less than the $2,000 deduction, which is now $50,850. So apply 22% to that, and you have $11,187. When you add everything up, your tax bill will be $16,613. So you saved a good $440. But remember, you spent $2,000, which means you're still roughly $1,560 out of pocket. So unless you actually need the piece of furniture, you've actually lost money. But unfortunately, a lot of people, especially business owners, rack up expenses so that they can use them to offset their tax bill. But while writing off these expenses does feel great, they also forget that unless they need the things they spent money on, they aren't actually saving money with this. Now, before we get back into this video, for all my small business owners and real estate investors, do you want to pay the least amount of taxes possible for this year? Do you need more money in your pocket to scale your business from 5 figures, 6 figures, or even 7 figures? If the answer is yes, for a limited time, I'm offering a free tax analysis where I go through your previous tax returns past really 2 years to see whether you overpaying and give you a blueprint on how you can save on your taxes for this year. If you like this, go to the website below for more information. Now, let's get back to the video. In fact, they are losing money. This is the second misconception about tax deductions, is that they're always valuable. Other common misconceptions about tax deductions is all business related expenses are tax deductible. The IRS defines deductible business expenses as business costs that are ordinary and necessary. This includes things like office lease costs, equipment rental costs, employee training expenses, advertising and marketing costs, and so on and so on. However, when it comes to non-deductible expenses, it's a little bit of a gray area. So some of these are like meals with clients, office snacks, and personal car that you also use for business purposes are partially deductible. Entertaining clients, however, is not deductible. 2 is tax deductions reduce your gross income. So the truth with this is, while all tax deductions reduce your taxable income, not every deduction is crafted the same. There are 2 broad types of deductions. Above the line deductions, which are subtracted from your gross income before your adjusted gross income, otherwise known as AGI, is calculated, and below the line deductions, which are subtracted from your AGI. Above the line deductions like IRA contributions, HSA contributions, student loan interest, and health insurance premiums for self-employed persons are particularly important because they reduce your AGI, and your AGI can determine your eligibility for other deductions and even credits. 3 is tax deductions can be carried forward. This is not entirely wrong. Some tax deductions, such as business and capital losses, can be used to offset profits in future tax returns. However, most other deductions can only be used in the year that they are incurred. That means you can only offset up to your taxable income, and any additional deduction would not be useful. All that said, tax deductions aren't completely useless. You just have to change the way you think about them. Increasing your expenses to, in turn, increase your itemized deductions will not save you money as much as you think. What you want to do in turn is turn your tax deductions into investments. That way you reduce your tax bill while also building wealth. How to use tax deductions the right way? So for me, it's starting out with maxing out your 401k. A 401k plan is a retirement plan that you can either take through your employer or your business. In the latter, it's also known as a solo 401k if you have your business. Basically, you put money into this account from your gross income towards your retirement, so you don't pay any taxes up front. This money is then invested in low risk assets like mutual funds, stocks, and multiplies tax free. Once you hit retirement age, which is 59 and a half, then you can start making taxable withdrawals. Number 2 is set up a traditional IRA. Now, a traditional IRA works the same as a 401k in that the taxes on contributions are tax deferred. You can't open an IRA on your own, so you don't need to do it through your employer, and can have it alongside your 401k. Moreover, contributions to both can be deducted from your taxable income in the same year, which can mean more savings for you and more wealth building. So I just want you to keep in mind, however, that the tax deductible benefits of your traditional IRA contributions will be limited after a certain income threshold, and depend on whether your spouse has a 401k as well. Number 3 is open a health savings account. So what if I told you that you could save for your future medical expenses tax-free, and while those savings sit and wait to be used, they are invested and earning you tax-free gains. HSA is one of the best deductions you can take advantage of because 1, it's an above the line deduction, and 2, it comes with a triple tax benefits. That is tax-free contributions, tax-free growth, and tax-free withdrawals. However, you have to be under a high deductible health plan and can only make withdrawals for qualified medical expenses like medical care, dental services, vision care, and prescription meds. This year, the maximum contribution for your HSA is $4,150 for an individual and $8,300 for a family. Number 4 is invest in rental property. Real estate is without a doubt one of the best tax shelters. Apart from writing off your expenses as you would for any other business, you also get to claim depreciation on your tax returns. Basically, you're deducting the cost of buying and improving the property over the useful life of the property. This deduction is so crucial because it can offset most, if not all, of your rental income. So if you pay a little, if any, tax on your rental income, this will completely wipe it out. Number 5 is start a small business. Starting a small business is one of the best ways to turbocharge your journey to wealth. Whether you're doing it as a side hustle or a main hustle, the earning potential of the business is unlimited, which can't be said about your 9 to 5. But something most people don't know is that a small business can also significantly reduce your tax bill. Basically, a small business increases your tax deductions from office expenses to employee expenses to even car and travel expenses. A lot of business costs are deductible. The best part though is once you start making profit, you can use losses from your initial years or months to offset some of those returns on your tax bills. Remember though, don't spend money on business expenses you don't need to get a tax deduction, as deductions don't offset dollar for dollar. Now over to you. Have tax deductions worked for you? Drop your thoughts in the comment sections below, and if you want to learn more tax saving strategies, subscribe and turn on your notifications. Want more? Click on the next video below. See you in the next one.